Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Welcome to the first episode of Accredited Investor Markets Radio. I am your host, Chris Cahill. Today is September 12th, 2014. As the man said, the show is focused on educating investors about alternative assets. But keep in mind, this radio show is not just for accredited investors. If you are an investor, accredited or not, this show is for you. Yes, the focus is on alternative assets, that is, investments in anything other than publicly traded stocks, bonds, and mutual funds. However, we here at Accredited Investor Markets Radio aim to provide solid information to investors from all walks of life. To be clear, there are many ways you can invest in alternative assets even if you are not an accredited investor. Whether you do and to what extent you should will be something we will talk about a lot. AIMkts is 100% free to you. No subscription or sign-up is required. AIMkts carries no advertising from any private equity firm, venture capital firm, hedge fund, bank, broker, consultant, or wealth advisor, or from any firm involved in the securities or investment management industries. Our format is going to be the same each week. I will spend the first few minutes of each episode talking to you directly about some of the things I've read about in the past week or so that I think you ought to know about. Then I will introduce our guest. Sometimes I'll conduct the interview, and sometimes the interview will be conducted by AIMkts contributing editor, my colleague, Alicia Purdy. Each episode will be a half hour long or thereabouts. Now, first, who is an accredited investor? Well, you are, if your net worth exceeds $1 million without factoring in the value of your primary residence, or if you earned more than $200,000, and that's $300,000 if you are married and filed jointly, during each of the past 2 years, and you reasonably expect to do so again this year. I think I've said enough for now. Let's get to our guest. This week, I have with me Vanessa Schoenthaler, a securities attorney based in New York City. Vanessa is a founder of the law firm Qashu Schoenthaler. She advises her clients with respect to fund formation and operation, private equity and venture capital transactions, private placements of equity, debt and hybrid securities, initial, secondary, and alternative public offerings, exchange listings, corporate restructurings, mergers, acquisitions, and dispositions, joint ventures and strategic alliances, and matters of corporate governance and regulatory compliance. Vanessa, thank you for joining us.
Thank you for having me.
Well, Vanessa and everybody listening, we here at Accredited Investor Markets Radio like to say the following to define an accredited investor. You are an accredited investor if your net worth exceeds $1 million, excluding the value of your primary residence, or if you earned more than $200,000 or $300,000 if married filing jointly during each of the past 2 years, and you reasonably expect to do so again this year. So that's an accredited investor. Vanessa, you're here to tell us what is the significance of being an accredited investor.
Well, the way the laws are set up here in the U.S., whenever a company or fund or any other entity wants to go out and offer and sell securities, they have two options, really. They have to either register those securities under a complex system of federal and or state laws and then comply with a number of related regulatory requirements, or they can qualify for an exemption from registration. Certain of the exemptions available focus on the kind of investors that securities will be offered to, with accredited investors being one kind of investor. The reason that offers and sales to accredited investors are exempt from registration is because accredited investors are thought to be persons who are able to bear the economic risk of investing in these securities that haven't been registered. And what this means is by virtue of being an accredited investor, you'll generally have access to investment opportunities that aren't available otherwise to the general investing public. These include things like securities of private companies, securities in hedge funds, venture capital funds, private equity funds, and the like.
Okay, so accredited investors are less vulnerable in the eyes of the protective agencies like the SEC, and therefore should, in the judgment of Congress, have access to more types of investments. And you were referring to the securities of private companies, etc. Okay, great. How does an accredited investor find out about these offers?
Well, traditionally, because the offers were private placements, they were private offerings, and if you were an accredited investor, you either found out about the offering directly from the company if you had an existing relationship with, say, a company that was raising money, or through an intermediary like a broker-dealer or a placement agent. Maybe you have a brokerage account with a bank that does private placements, and so that you might find out through those means. But most often you needed to have a pre-existing relationship with somebody who had access to that kind of deal flow.
So nowadays it's been loosened. You don't necessarily find out about it from a friend or a business associate or an investment relationship. In fact, aren't there online platforms being developed to draw accredited investors to them and match them up with opportunities?
Yeah, that's right. About a year ago, when the ban on general solicitation was lifted in September of 2013, part of the Jobs Act was to permit platforms to host these offerings by companies that are generally soliciting private placement and seeking to raise money. And so now you can go online and as a result, you can, Google search for, say, you're interested in a particular area, and like real estate is very popular, and you might be able to find any number of platforms that allow accredited investors to sort of peruse the deals that they have on those platforms and participate in that way. So it's sort of opened up the market entirely.
To the benefit of Accredited Investor Markets Radio, for we intend to discuss this matter with several platform representatives we have lined up to talk with in ensuing weeks. So, Vanessa, how many accredited investors are there in the United States?
Well, there's a lot of different estimates, and no one really at this point keeps records. Plus the number's fluid because individual net worth and income changes all the time. But generally, we're talking about somewhere around 8 million individual investors.
Well, that sounds like a lot of investors. Out of that 8 million, how many of them do you suppose or have been estimated to have ever invested in private placements?
That's a great question. And again, nobody really keeps track historically of that information, so it would be hard to say. I think before the Jobs Act, the number is really only going to be a very small fraction of the total number of accredited investors. Now that general solicitation is available, I think that market's going to expand quite a bit.
Okay. Once you say, I think that market's going to expand, a lot of different imaginations will go to work to try to serve those people, take advantage of that, and maybe make more wealth for everybody. But why? Why has it been so small?
Well, again, historically, the securities laws have prohibited general solicitation because private offerings, by their very nature, they needed to be private in order to qualify for the exemption from registration. So they, like we discussed previously, they could only be sold to, if you're going out and raising money, you could only sell the securities to someone whom you had a pre-existing relationship with. So you needed to find accredited investors as a company, and those investors had to be, you had to find them through either existing relationships that you had directly or through, if you had an intermediary like a placement agent or a bank, through their relationships. But it was all very network-based. And then the Jobs Act came to be, and the ban on general solicitation was eliminated in September of 2013. So now there's this whole new category of exempt offerings that allows companies to go out and advertise and do all kinds of general solicitation, anything really, as long as they ultimately sell their securities only to accredited investors.
So a company, I should say an issuing company, before would have had to potentially register a given offering, and now would have the choice between registering the offering and going through a private placement, presumably because now it could go through private placement and attract more capital. Is that about right?
Yeah, that's right. I mean, it's essentially opened up private offerings to the public.
And we say registration blithely like it's nothing, but it's a huge deal, isn't it?
It's a tremendous process, and not only is it time-consuming and expensive, but it comes with all kinds of ongoing regulatory compliance. You don't just register and sell securities. You register, you sell the securities, and then you have to comply with all of the various disclosure requirements, the annual reports, the quarterly reports, current reports. There's a lot to it. It's not something to be done lightly.
Okay, and being relieved of that then presents more opportunities both for issuers and accredited investors. Okay, we talked about accredited investors. That's our favorite phrase here at Accredited Investor Markets Radio. But a lot of the attention regarding the Jobs Act has gone to another word we haven't used, which is crowdfunding, which is a different thing. You've been quoted before as saying that the lifting of the ban against general solicitations for accredited investors is far more significant than the crowdfunding provisions of the Jobs Act. Now, why do you say that, or why did you say that? And if that's the case, then why is there so much noise about crowdfunding and, in comparison, so little, outside of Accredited Investor Markets Radio that is, about the lifting of the ban against general solicitation?
Well, I think the lifting of the ban on general solicitation is more significant because there's a large existing market for exempt offerings. Even before general solicitation was permitted, the SEC does keep numbers on what kind of private placements are being done and how much is being raised, who's doing them. And in 2012, the market for private offerings was $898 billion in capital was raised. And it's not too far from what's being done in the public markets, which was just $1.2 trillion in the same year. So it's a huge market. It's very robust. It's an accepted market, and there's just a lot of activity there. Plus, there's no limit with the exemption that allows for general solicitation on the types of issuers that can use it or the amount of money that they can raise. So it can be private companies, it could be hedge funds, private equity funds, and they can raise an unlimited amount of capital. Whereas in contrast, the crowdfunding rules, which haven't been implemented yet, they're only going to be available to private companies, certain types of private operating companies, and there's going to be limitations on both the amount of money that a company can raise in a period and the amount of money that investors can invest in a company. So it's a very sort of capped market. And then assuming the rules, when they are implemented, that they're not too onerous, there's still no market there yet. It's something that's going to have to develop. So it'll be a good alternative for certain types of company to raise money, but we're not really sure what it's going to look like. And there are other alternatives that are probably more appealing in some respects to companies. But the reason you hear a lot about crowdfunding as opposed to accredited investing is because there's a tremendous and vibrant startup community, and startups are very excited about crowdfunding because it's another avenue for them to raise money.
So there's a buzz.
Absolutely.
Well, speaking of the buzz, there was a recent article in Forbes magazine concerning the buzz, and it was about the South by Southwest V2V conference. I'll note first that the article included several quotes from David Manshuri of Asset Avenue, and he will be a guest on a forthcoming Accredited Investor Markets Radio broadcast. But on to substance, the author of the article found that at the conference a, quote, sense of frustration, end quote, was there regarding the Securities and Exchange Commission's delay in implementing a Jobs Act provision to liberalize crowdfunding for ordinary investors. There was even talk of potential SEC actions to disqualify some accredited investors from future ventures. So there's a negative buzz inside the positive buzz, I guess. Do you see reasons for a sense of frustration, and might the SEC actually restrict accredited investors?
Yeah, I mean, I understand the frustration because, in a sense, startups they're always looking for capital, and the wider the potential investor pool, the greater opportunity there is for funding. I think what gets lost from the entrepreneur's perspective is the fact that the SEC is not there just to facilitate capital formation, but it also has to protect investors and maintain fair, orderly, and efficient markets. So there's always the issue of striking a balance and considering, a range of different perspectives from all kinds of market participants. And so particularly in the case of something groundbreaking like crowdfunding, the process tends to be time-consuming, and there's a lot of compromise along the way, and that can be frustrating. But insofar as restricting accredited investors, that refers to, the SEC is required now by the Dodd-Frank Act to reconsider the definition of accredited investor every 4 years. And that review might result in restrictions in the sense that the net worth test and the income test may change in order to keep pace with inflation. But at the same time, the SEC is also considering expanding the definition to include certain professionals like CPAs, CFAs, investment advisors, and lawyers, and certain individuals with certain kinds of educational backgrounds like finance, accounting, or economics in the accredited investor pool, even though they may not necessarily meet the income or net worth test. So we're not really sure what that's going to look like, and the SEC is not really doing anything at this moment other than considering it. So it's not something to be too worried about, at least I don't think.
All right. Well, thank you, Vanessa, for your extremely well-founded and well-put perspective on all these things.
Well, thank you for having me.
That was Vanessa Schoenthaler, securities attorney based in New York City and a founder of the law firm of Qashu and Schoenthaler in New York. And we were very glad to have her. Thank you all for listening in on this Accredited Investor Markets Radio presentation. Let's do this again soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.